2008, the crisis was loud. You saw Lehman Brothers employees walking out with cardboard boxes. You saw lines of panicked depositors stretching around the block. It was a spectacle. But the crisis of 2026, it is silent. Right now, as I speak, there are hundreds of office towers across America that are technically bankrupt. The owners stopped paying the mortgage months ago, but the bank hasn't foreclosed. Why? Because if the bank takes the keys, they have to admit the building is worth half of what they loaned on it. And if they admit that, the bank becomes insolvent too. So they made a deal. The bank pretends the loan is good. The owner pretends they can pay. And they both pray for a miracle. Well, the prayer time is over. The miracle didn't happen. And in a minute, I'm going to show you the one chart. The maturity wall. That proves why 2026 is the year the silence breaks. Welcome back to the Wealth Archivist. If you're a retail investor, you have been hearing about the commercial real estate crash for 3 years now. You've heard the warnings, but the sky hasn't fallen. The S&P 500 is still trading, so you might be thinking, was it all a false alarm? The answer is no. It wasn't a false alarm. It was a delayed fuse. In this video, we're going to do a forensic accounting of the U.S. banking system as we enter 2026. You are going to learn about the $1.5 trillion wall, why the extend and pretend strategy legally expires this year, and why 19% of U.S. office space is mathematically un-refinanceable. We will look at the Fed's checkmate, and why they can't save the banks this time without destroying the bond market. Most importantly, I will give you the playbook, exactly how to position your portfolio for a credit contraction without panic selling. A quick note before we open the file. I'm not here to sell you a bunker. I am here to look at the balance sheets that the mainstream news finds too boring to cover, because that is where the risk is hiding. This is for educational purposes only, so please do your own due diligence. Let's begin. To understand 2026, we have to briefly look at what happened in 2024 and 2025. 2 years ago, everyone knew commercial real estate was in trouble. Remote work had emptied the offices. Interest rates had jumped from 0% to 5%. By all laws of economics, waves of defaults should have happened then, but they didn't. Why? Because banks engaged in a strategy industry insiders call extend and pretend. Here is how it worked. You own an office building, you owe $100 million, the loan is due, but because interest rates are high, you can't afford a new loan. In a normal market, you default, but the bank didn't want your empty building, so they said, tell you what, we won't make you pay off the principal yet. We will extend the loan for 24 months, just keep paying the interest. They kicked the can down the road. They hoped that by 2026, interest rates would be back to zero, or everyone would return to the office. Well, look around. Rates did not go back to zero, and remote work isn't going away. Now those 24-month extensions are expiring. The pretending is over. According to data from Trap, approximately $936 billion in commercial loans are maturing in 2026 alone. That is a 19% increase from last year. This isn't a wave. It is a tsunami, and it is hitting a banking system that has run out of favors. Let's look at the math of why these loans cannot be refinanced. This is what we call the LTV Trap. Imagine in 2021, you bought a building for $100 million. The bank loaned you $70 million. That is a loan-to-value ratio of 70%. Safe. Today, in 2026, that building generates 40% less income because half the floors are empty. According to the Green Street Commercial Property Price Index, office values are down roughly 36% from their peak. So your $100 million building is now worth $64 million. But here is the problem. You still owe the bank $70 million. You are underwater. Your LTV is over 100%. Legally, a bank cannot refinance this loan. No regulator will allow them to lend $70 million on a $64 million asset. So the bank has two choices. Choice 1, demand you pay down the difference in cash, which you don't have. Or choice 2, foreclose. For the last 2 years, they chose option 3, ignore it, but with regulators implementing the Basel III endgame rules, which require banks to hold more capital against risky loans. Regulators are forcing the banks to mark these assets to their real value. Pause for a second, ask yourself this. If you legally couldn't sell your house for what you owe on it, and the bank demanded the money tomorrow, What would you do? You'd walk away. That is exactly what big institutional investors like Blackstone and Brookfield have already started doing. They are mailing back the keys. Now you might say, who cares if a few developers go broke? The problem isn't the developers. It's who gave them the money. The giant banks, J.P. Morgan, Bank of America, they are mostly fine. They saw this coming and reduced their exposure. The danger is in the regional banks. These are the banks with 10 billion to 100 billion in assets, the banks that lend to your local businesses. According to Goldman Sachs research, small and regional banks hold nearly 70% of all commercial real estate loans. For many of these banks, CRE loans make up 300 or 400% of their total equity. If just 10% of those loans default, the bank's equity is wiped out to zero. The bank fails. We saw a preview of this with Silicon Valley Bank, but those were isolated incidents. What happens in 2026 when 50 or 100 regional banks face this math at the exact same time? It creates a credit crunch. When banks are scared of dying, they stop lending to everyone. They stop lending to small businesses. They stop lending for car loans. They call in lines of credit. This is how a real estate problem becomes a you problem. It sucks the liquidity out of the entire economy. History rarely repeats, but it rhymes. We are seeing a setup eerily similar to the savings and loan crisis of the late 1980s. Back then, small banks had lent aggressive amounts of money to commercial real estate during a boom. When interest rates rose and tax laws changed, the values collapsed. More than 1,000 banks failed. It cost the taxpayer billions and dragged on for years. But there is one major difference today: speed. In the 1980s, you had to physically go to a bank to withdraw your money. Today, as we saw in 2023, a bank run happens in seconds on a smartphone. If the 2026 maturity wall starts toppling regional banks, the flight of capital will be instantaneous. And here is the kicker: the Federal Reserve's emergency tool, the Bank Term Funding Program, which saved the banks in 2023. That program is gone. It expired in 2024. The safety net has holes in it, so is a crash guaranteed? In finance, nothing is guaranteed. Let's look at the surprise scenario that could save the system. It's what I call the inflationary bailout. If regional banks start falling like dominoes in mid-2026, the Federal Reserve will face a brutal choice. Choice 1. Let the banking system collapse, which leads to a deflationary depression. Or choice 2. Print the money to fill the hole. History tells us they always choose option 2. They might not call it QE. They might call it liquidity support or yield curve control, but the result is the same. They inject trillions of new dollars to buy these bad debts. Here is the catch. If they print trillions to save the commercial real estate market, what happens to the dollar in your pocket? It gets diluted. This is why we see gold hovering near all-time highs. The market is sniffing out a future bailout. Smart money is betting that the Fed will sacrifice the value of the dollar to save the value of the banks. So how do you protect yourself? If you are a retail investor, you have 3 objectives: liquidity, insurance, and income. Step 1 is the Treasury mode. Consider holding your emergency cash in short-term U.S. Treasuries rather than a savings account over the FDIC limit. T-bills are backed by the government directly, not a bank balance sheet. Step 2 is hard assets. If the inflationary bailout scenario happens, paper currency loses purchasing power. This is the historical case for gold and silver. They are effectively insurance against central bank errors. You aren't buying them to get rich. You are buying them to stay rich. Step 3. Avoid the yield trap. Be very careful with high-yield real estate REITs right now. If a REIT is paying you 12% dividends, ask yourself, are they paying me from profit or are they paying me from their own liquidation? Many office REITs are looking cheap until they go to zero. Finally, you need to watch the canary in the coal mine. Keep an eye on the CMBS delinquency rate, specifically for office loans. TREP reports this rate recently hit around 11.7%. If you see this cross 15%, the dam is breaking. The banking crisis of 2026 won't look like 2008. There won't be lines on the street. It will be a quiet, suffocating pressure of higher rates meeting bad debt. The maturity wall is here. The extensions are over. Here is your watch list for next week. Number 1. Bank earnings. Watch the provision for credit losses line. Are they setting aside more money for bad loans? Number 2, the 10-year Treasury yield. If this spikes, the pain for real estate gets worse. And number 3, Federal Reserve announcements. Listen for any talk of new liquidity facilities. That is code for bailout. If you found value in this deep dive, make sure you are subscribed. We are archiving the wealth transfer as it happens, so you don't end up on the wrong side of history. I'll see you in the next file.